Hello, everyone, and welcome to Wealth Builders webinar tonight. We're so excited that we've got a special guest. Bill Bronchick is going to be talking about how to position yourself in the 2023 real estate market. I'm Mike Davis, one of the Wealth Builders real estate coaches, and I'm your host tonight. I'm along with Frank Pulley. Frank, you want to greet everyone as well as Bill Bronchick?
Everybody, welcome. Thanks for joining us tonight.
And
welcome, everybody. I'm Bill Bronchick, and I'll be presenting this evening, and I hope you enjoy and take action on what you hear.
Yes, and we're excited about this. Bill is just one of our great speakers, and we would like to know where you guys are joining us from. So in the chat section, if you could let us know that, and if you have any questions, feel free to enter that in the chat as well. Bill Bronchick is one of our speakers at the Wealth Builders Seminar, and that's our biggest conference. It's going to be coming up February 17th through the 19th. And so tonight we're giving you kind of a preview of our speakers on this webinar, and you're in for a real special treat because Bill is one of our favorite speakers that people love to hear at Wealth Builders Seminar. And if you've already registered, we can't wait to see you. If you have not registered, you can, and if you're going to be attending in person or live stream, you can go to wealthbuilders.org/events to learn more about that. So in this webinar, we're going to be learning a lot about what you need to do to prepare and position yourself in the 2023 real estate market. I mean, guys, it's just been a crazy real estate market, has it not?
Oh, yeah.
Yeah. But we were going to let Bill speak. We're going to have about 15 minutes of questions toward the end. So Bill Bronchick's an attorney, and he's one of America's top real estate attorneys in America. And you have so much wealth of information, Bill. I mean, I've known you now for a few years. And every time that Frank and I know Frank's known you for right after Noah got off the ark, but I mean, there's been so much information that we continually learn from you, Bill. So without further ado, welcome, Bill Bronchick.
Thank you so much, everybody. Thank you. Thank you for having me, and welcome everyone who's just joining us and the Wealth Builders crew. I want to thank them for all their great preparation and putting these things on. And I'm really looking forward to the annual Wealth Builders event. It's a big thing for me every year. Last year was a big event for me too, in many ways, as some of you were there remember. But today I'm going to be talking about how to prepare for real estate investing in 2023 and really beyond, because there's a lot of misinformation out there. There's a lot of speculation. There's a lot of people with opinions and advice about what's going to happen, what has happened. So let's see if we can break it down a little bit. A little bit about me for those of you who have never seen me speak before. I've been an attorney primarily in real estate for 32 years. I've been investing for 31 years. It only took me a year to figure out that being a lawyer pays pretty well, but it pays by the hour. And the problem with that is you run out of hours. Even though I charge a high hourly rate, I wanted something that could work for me when I wasn't working. And I learned that at my first closing, when I was sitting at a table with lots of people and I was the most educated person in the room and had the smallest check. I said, wait a minute, I think I'm on the wrong side of the table here. So I quickly decided to get into real estate. And since then, I've invested in 3 different cycles of real estate and in 12 different states. So I've been around the block a few times. I've written 6 published books, 2 of them bestsellers. And I ran the largest real estate investment group in the country for 18 years. I've been featured on major media outlets. There's some of my books you could find on the major bestsellers like Amazon and so forth. Me on major media networks and interviewed on a bunch of other media outlets as well. And by the way, I have no relation to these 2 guys, if that's what you're thinking already. I get that a lot. Does he look like that guy or that guy? Sort of a morph between it. So we're going to start with, I think, the 5 main factors affecting real estate in 2023. Now, these are nationwide factors. I'm going to dial in a little bit up to the local factors, but this is something that affects everybody nationwide. Number one, the obvious one, inflation and interest rates. So as we keep spending and spending and spending, now we're up against another debt ceiling, and we only owe $31 trillion, and each citizen owes $94,000 of that. And the more we borrow, the more our percentage of our budget becomes payments on the existing debt, and it becomes risky. So in order to attract people buying our treasury bills, we have to raise interest rates, plus the fact that a lot of factors are causing inflation, not the least of which are supply chain issues and gas shortages and so on and so forth, which has also caused mortgage rates to go up. Now, just FYI, the Fed rate, when they decide whether to raise or lower, it doesn't necessarily translate into higher or lower mortgage rates. Usually it does, but the mortgage interest rate is tied to the long-term bond yield. Right now, the long-term bond outlook, is looking like it's rising. That's why mortgage interest rates have risen. And that's because of people expect more inflation and more supply chain, and et cetera, in a recession. So as those things start to soften up, hopefully, then interest rates for the mortgages will go down. But as we've seen with the Fed rate hikes in the last 2 years, that not every rate hike translated into a mortgage rate hike. Some of them actually went down. Sometimes it's just cooked in because they expected it, and sometimes it's just because the short and long-term yields are moving in different directions. So of course we're going to see, kind of a wait and see. Inflation works for you and against you. And on the one hand, as a landlord, inflation is good because rents go up. On the other side of it, the cost of materials, your property taxes, your insurance rates are all going up. And of course, interest rates, as they go up, that means the buyer has less buying power, and therefore that could and has in some cases led to sellers dropping prices. When interest rates are low, people could buy more house, more buyers come in the market, and it's simple supply and demand. People talk about all kinds of factors, and it really boils down to two things: supply, demand. I was an economics major in college, and I exceeded very well in that. And I understand that real estate is about supply and demand. And we're going to talk more about supply, but in terms of demand is affected by several things. One is the number of people buying, which is affected by interest rates. If interest rates are rising, more people are going to pull out. But on the other hand, when the stock market's not doing well, hedge funds and big corporate entities are running in and buying real estate because it's a better return than the stock market in many cases. And as many as, depending on the market you're in, as many as 25 to 35% of investor buyers are actually big corporate hedge funds buying up, or REITs buying up real estate and competing with buyers. So that's very interesting to see what's going on there. The next thing is low supply of housing for sale. So again, supply and demand. Although demand has dropped because of rising interest rates, so has the supply of houses. So I'll give you an example. Normal supply in my market of Denver, Colorado has been traditionally about 25,000 homes for sale at any given time. In 2008, we reached about 33,000. So we were oversupplied, and that's what led to the downfall. Since 2012, we've been somewhere between 3,000 and 5,000 houses, which is very low. And if you have low interest rates, high demand, and low supply, prices go up, and they did substantially in my market for 10 years almost. And then all of a sudden, it came to a halt last spring. When interest rates went up, demand dropped, and supply, because people were not willing to drop their prices enough, started increasing. And the news headline said supply is tripled. Well, At that point in January of last year, supply was down to 2,000 homes. So it went from 2 to 6 with normal of 25. There's nothing really to panic about. Now sellers are pulling their listings and either renting them out because they have low interest rate mortgages, or they're just staying and just waiting to see what happens next year if the interest rates drop and buyers are willing to pay more for houses. So now inventory has split in half again. So at the same time, we have demand dropping and supply dropping. And of course, these are just generalizations, as we'll see. It's really about the local markets that you're in that will determine supply and demand and thus prices. We're seeing a higher supply of rentals because people are, again, pulling their houses off the market, and less demand because rents have been really increasing over the last 10 years. It's been a great time to be a landlord, but all of a sudden it's coming to a halt for a number of reasons. Number one, as I said, people are pulling their listings for their homes and then renting them out, causing more supply. And that's usually higher end homes. So if you deal in lower end homes, it's not as big of a deal, but in general, people are moving in together, moving in with their parents, doubling up. So what happens is you have fewer tenants overall because of these factors. And now that's going to cause rents to, in some cases, fall, in some cases flatten, and in many cases, depending on where you are, just increase very slightly from here on in. So it's a very interesting dynamic. The fourth factor is workplace changes. As we know, Zoom has changed our lives, has changed the workplace habits. And a lot of people who had companies with, a suite of maybe 15 offices and 15 employees realized, well, this COVID temporary thing worked out okay, and people can work from home, and we only need 5 offices, and we'll just share offices and switch people on and off different days of the week, and people can work from home half the time. Now, what has that done? Well, first of all, the office supply has gone through the roof. If you're in the office building market, it's terrible. It's terrible because people are just not renewing their big leases. They're either abandoning the office concept and going completely virtual or semi-virtual, or they're just renting smaller places. Also, people realize I don't have to live 15 minutes from my job downtown. I could live out in the suburbs or in the rural, somewhat rural areas an hour away, because if I only have to commute 2 or 3 days a week, it's not that bad. So what we're seeing is higher demand for the sort of super suburbs, the distant suburbs and some of the quasi-rural areas, the smaller towns that are an hour away from the major cities starting to boom. And that could be an opportunity for us as investors. And I think that trend will continue. I think this is a permanent change of remote workplace. I know, unless you work for Tesla, where everybody has to come in, most employers are okay with this remote employee situation. And then there's, of course, regulatory uncertainty. In the last 2 years, for some reason in my market, the state and the city of Denver have gone on a warpath on landlords, requiring registration of rental units, inspections every year. Rent control is coming next. They limit what you can charge for late fees and when you can charge them and how many times you can charge them. And they're looking now at proposals to limit how many times a year you could raise the rent on a month to month. So it's really, it's a big thing. And even in Congress, it never got to the floor, but it was in committee, a regulation that, get this, would limit the tax deductions available for big corporate home buyers. So big corporate home buyers who are buying up houses and edging out, would-be owner occupants, they're punishing the big companies by taking away the tax benefits of real estate. I don't know if that gets through the full Congress, but just to give you an idea of what type of regulations are coming and how they will affect you as a real estate investor. So be on the lookout for those types of things. All right, so how do we prepare for real estate investing in 2023? Tip number 1, don't listen to the news, get the facts, especially social media. If you get your news about real estate off social media, you're getting just a hack job from someone's opinion with a super sensationalized headline, and then you read the article and realize what I'm talking about. I saw an article that said that rents tumbled nationwide. So I read the article, I clicked on it, and it said that for the last 10 years, rents have gone up X% a year. And for the first month, they dropped 0.3%. 0.3%. 0.3% is like 30 cents for a landlord charging $1,000 a month. You think about that. You got to take that with a grain of salt to some, in some respect, and look at the facts. The facts are what you want, not the opinions, not the regurgitated opinions, but the facts. So first, there is no such thing as a national housing market. As much as they talk about that on the news, real estate is local. It's all local. It's a compilation. Now, the 5 things I talked about before, they'll affect everybody, but there is no housing market. So when they say prices went up X%, rents went down Y%, that's a national figure, and it has no bearing or relevance to what may be going on in your local market. Now, certain things that affect everybody, regulatory policy in the nation, and the nationwide thing, the US regulatory, interest rates, tax policy, okay, and supply. And supply shortages may be different depending on what state you're in anyway. So there really is no national market. So when people say the housing market did X last month, or the housing market did Y, or the prediction for the housing market is this, take that with a grain of salt, because it's really not that important. We want to look at neighborhoods, not cities, not states. Even within a city, you have different neighborhoods. And in neighborhood 1 could be doing something different than neighborhood 2 or neighborhood 3. We want to look at neighborhoods, subdivisions. What is the supply and demand in there? What factors are affecting those specific areas of your market? Because it really doesn't matter what's going on in another city, in another part of the state, or even another part of the city, if you are looking at neighborhood by neighborhood. So that's how we want to look at it. It's too early to make any predictions. People are saying that housing has dropped already 20%, 10%, may drop as much as 30%. The reality is we don't know yet. Here's what happened. Let's get a little history here. Rewind back to 2020. COVID hits. We had before that 8 to 10 years, depending on your market, of growth in prices, low interest rates, housing prices going up, low supply, high demand, etc. 2020, everything comes to a halt because of COVID. House showings are not happening, closings are not happening, and that went on for, the better part of 8 months. So what happened in 2021 is all this pent-up demand exploded the prices in 2021. In my market, depending on the neighborhood, it went up 20 to 30%, in some areas 40% in 1 year. And that's crazy, and that's not normal. That's not normal. So from 2020 to 2021, people said, well, things went up 20%. So by January of 2022, they're thinking, I'll mark my house price up another 20%, because the year before it went up 20%, but that wasn't a normal year. That was an aberration. And what happened? First, people balked at the 20% increase. Second, interest rates hiked and people could buy less. So sellers had to adjust. So for example, if they bought it in 2020 for 400 and their neighbor sold their house for 500 in 2021, and they think they can get 600 and they didn't get it, so they dropped it to 550. And everyone said, oh my God, prices are plummeting. No, the asking prices are plummeting. Then they drop it to 525. Then they drop it to 500, and in some cases sold. Remember, year over year, it's an even Steven. If things sold in the neighborhood 500 last year, 500 this year, it didn't go down. It's just that the asking price was too much and they had to drop it to meet the realities of the marketplace. A lot of people didn't drop them. They just held steady. So things that were listed in the spring of last year, a lot of them didn't sell. And they didn't relist it, or they just pulled it off and rented it, or some people are still listing it. It's really too soon to know what the normal market looks like. I think now that things have stabilized in terms of the interest rates, high as they may be, and the market is sort of stabilized in terms of inflation, it's not going up, it's not really going down much, that we need to see what sells January, February, March, maybe even April, May, to determine what's really happening. Is the average sales price in a neighborhood down? Because what a lot of people are seeing, which is a false number, is that the median sales price has dropped in a particular area. Now, median doesn't mean average, median means middle, the most common number. Which are selling faster? $700,000, $800,000, $900,000 homes, or $300,000, $400,000, $500,000 homes? I think the answer is obvious. The lower end homes are going to sell quicker because there's less of them. There's fewer of them. Builders now are building, in the last 10 or 15 years, 20 years, have built bigger homes, more expensive homes, not the cheaper ones. So if the median price has dropped, that could just mean that more cheap houses sold than expensive ones. It doesn't mean that the values of anything has dropped. It just means that the median price has dropped. So don't look at that and say, well, the median price dropped 10% and therefore my house dropped 10%. Not necessarily. It's really, like I said, a neighborhood by neighborhood thing. And it's a little too early to make predictions. But if you want to be safe, let's assume the worst and you'll lessen your risk. So if you're going to buy a house and you're going to fix it and flip it, and you're expecting it to be worth in 4 months when you list it what comparably a house sold 3 months ago, that's a 7-month difference, you may be wrong, because we don't really know what the resale value of this house is. It's a moving target. So just assume the worst. Assume, okay, if the comparable sales show 3 months ago they sold for 600, I'm going to assume I could sell it for 550 and buy it accordingly. Okay, so be safe, and you might be surprised, you might get 600, but assume the worst and you'll lessen your risk. Okay, because obviously it looks like the market may adjust. The odds are in that favor. And I say it's too early to tell. The factors look that way, that prices are softening. And again, neighborhood by neighborhood, city by city, price range by price range. Okay. All right. Tip number 2, learn the trend. The trend is your friend. So in the neighborhoods you're investing in, not the city, not the state, not the national numbers, what is the trend for the average days on market that houses are taking to sell? Now, as we know, 2 years ago, well, not counting 2020, but a year and a half ago, or even 2 years ago by now, sometimes the days on market was 1 day, 1 week. And that's really quick. In a normal market, things take 30 to 45 days to sell. So if things are they went from 1 day to sell or 1 week to sell to 6 weeks to sell, that doesn't mean the bottom is dropping out. It just means we're returning to normal. If it's taking 90 days, either one or two things is happening. Either the market's really softened, the demand has softened, or the sellers just haven't come to reality yet. And I think that's why we need to wait and see what the numbers are this spring, because last year sellers were up against a very rapid change in the market and weren't willing to drop their prices dramatically and had listed them too high in the first place, unrealistically. So it's hard to use last year's numbers and get an idea of what's going on. Number 2, what's the trend of listing prices, the asking price, versus what they're selling for as a percentage? Are they selling for 100%? Because remember, a few years ago, you'd ask 300 and someone would bid 330. They bid over the asking price just to get it. Now we're seeing a different trend. So are they selling for asking price, which means that people are listing them reasonably? Are they selling below asking price? What is that trend in your local marketplace? And I would say, when I say marketplace, I mean like zip code. within a zip code. What is the housing supply trend? How many houses for sale in a market? Now, the measure of this is what's called months of housing supply. I like to call it the supply curve. And the way you get that is you look at how, if nothing went for sale new, how many months would it take to liquidate the existing listings for sale? So for example, in a particular area, let's say a zip code or two, you had 30 houses for sale and 5 have sold in the last 30 days. It's simple math, 30 divided by 5 is 6. That means it would take 6 months to liquidate existing listings of 30, okay, at 5 per month. Now, 6 months is a normal balanced market. In 2009, 10, 11, we were at 9 months, 10 months, 12 months. And then up until a year ago, we were at, 2 months or less nationally. And in my market, 3 weeks of supply. So that's abnormal. And I don't expect that to continue. And it's discontinued. But what is the trend of these things? Are they going up or down? What is the listing versus sales price trend? Is the number going from 98% to 92%? There's the days on market going from 10 days to 20 days, and which direction is it moving? And you have to just know what those trends are in your market. And rents too. Rents, are they moving upward or downward in your particular area that you're planning on buying rental properties and owning rental properties? Okay, tip number 3, how to find good deals. Everybody wants to know that, right? Well, the multiple listing, or the MLS, that the brokers use is way too efficient. It's like the stock market almost, because it has the maximum exposure to everybody. Most sellers who list with the MLS are not that motivated, meaning they're not desperate, but they want to sell. They want to get all the equity out of their property. They want full price so they can take all that money in equity and buy another house. So it's not that likely you're going to find a super deal on the MLS unless they're advertising as such, like a fixer-upper, needs TLC, bank-owned, foreclosure, or something like that. And plus, again, supply is really, really dwindling. There's just not that much. We must find the sellers either before or after they list with a real estate broker. So before is a for sale by owner that maybe someone's advertising for sale by owner, or they could be a for sale by owner, meaning they're not actively advertising with a sign, but maybe they're in a divorce or a foreclosure, or they have job transfer or out of work or whatever. And for whatever reason, they really should sell their house. And you could find them before a real estate agent gets a listing and marks the price up dramatically. After is what we're going to see a lot of now. You can buy a list in your market of listings that expired, meaning they listed it with a real estate agent for 3, 4, 5, 6 months, and it didn't sell. Now, that could be for a number of reasons, not the least of which could be the seller's an idiot or is just really stubborn and won't drop his price, or just doesn't feel the need to, or, but it could be that the realtor priced it so high, or the seller pushed the realtor to list it so high that it just didn't sell. And what happens is when you list a property, let's say a property is like objectively worth $400,000. If you list it for $399, it's going to probably sell rapidly. If you say, well, let me try $430, and then if I don't get $430, I'll drop it to $420, then $410, then $405, then $400. The problem with that method is twofold. One is the price point drop is 400. So people look in ranges. If they're looking from 350 to 400, they won't see your listing until it gets down to 400. So you can drop it from 430 to 420. And if they're not looking in that area, that price drop is meaningless. The other problem is that listing becomes stale. Everybody says, oh, that house. They're on realtor.com and they say, oh, that house. And I've seen those pictures. I've seen this house before. That it's been there for a while, or it's the springtime and they've got snow in the pictures, right? Or vice versa. So those could be potentially good listings because people's motivations change. Someone might say after 6 months, well, I'm not dropping my price. And then something happens, a loss of a job, a divorce, death in the family, whatever. So you could contact people who haven't listed yet or listed and it didn't sell. Both could be potentially good deals. You must deal with motivated sellers. That's the bottom line. The average person, 95% of houses for sale, they're unmotivated. I mean, they're motivated to the extent that they want to move and they have a motivation, but they're not highly motivated. They're not, I hate to use the word desperate because we don't want to take advantage of people. That's not what we do as real estate investors. But they have to be highly motivated to make a deal on price and or terms. Okay. Tip number 4, how to evaluate good deals. Number 1, remember, price isn't everything. Terms are important too. And I've given a lecture to many, many, many real estate broker offices with 50 or 100 agents and explaining to them that the seller who refuses to drop their price may be flexible on terms. So if someone has a house that they paid, let's say, $500 for, and they put $100 down and they owe $400, and they listed it for $700 and refused to go below $600, they have $200,000 in equity. Who says you have to pay them 20% down? Maybe they'll do an owner carry where the seller carries the payments and they'll take payments for their equity, or at least most of it, so you don't have to put a lot down, as long as you give them $600. And that's going to be a phenomenon we're going to be seeing a whole lot more of. What is your back end strategy when you evaluate a deal? What are you going to do with it? Are you going to rent it? Or are you going to fix and sell it? Or are you going to do something else? You're going to use it as an Airbnb property? And more importantly, what is your back end strategy? So if you did buy it to rent it as an Airbnb and then your city changed the rules overnight, then what? Can you still rent it long-term and make money? Can you sell it for what you paid for it? You know, you got to have a back-end strategy and a back-end strategy, right? Number 5, finally, then we'll take some questions. Assess your resources. So number 1, look at cash or CDs or something you can convert to cash. Maybe a home equity line of credit against your home where you can borrow, not long-term, but short-term to buy houses. Friends and family, that's sometimes a good place to go, sometimes not, because if they don't understand real estate, they may not want to do it, or maybe they understand it enough to be greedy and they want too much of the deal. But, you know, friends and family, if they've got cash or their own home equity line of credit, or maybe even an IRA or 401k they can lend you money out of, could be a viable alternative for a resource to buy real estate. A bank line of credit. A lot of banks and credit unions will give you $25,000, $50,000, or even $100,000 line of credit. Now, if you have your own business already, it's very easy to get a line of credit these days. The interest rates are a little high, but it's not the cost of the money that counts. It's the availability of it. Those of you who were around in real estate in 1979 or 1982, you remember when interest rates were 14% or 15%, and on commercial, 23%. Did people still buy and sell real estate? Yes, they did. So it's not necessarily what you pay for the money, it's the availability. And remember, paying 10% interest, which sounds very high, 12% interest, is still more profitable than borrowing or partnering with your friend or family who wants half the profit. You understand that? So think about that one. And then finally, institutional financing. So going to a mortgage company or a bank like a Wells Fargo, a US bank or something like that, or Chase, or your local mortgage broker, put 20% down cash, finance 80% mortgage, and that's what you got. Okay? Just remember, a lot of people think that cash is really important, or having cash to buy real estate is important. Here's the thing. Tony Robbins said it very well. Lack of resources is not the problem. It's lack of being resourceful. It's lack of resourcefulness. So if you're a resourceful person, you will find the money to buy the real estate deals if they make sense. And I'll quote myself here, find a good real estate deal and miraculously, the money will find you. Find a lousy real estate deal, you're going to have a heck of a time finding someone to finance it. So find a good deal, the money miraculously just finds its way to you. Very, very important. Okay.
Awesome.
Wow, thank you.
All right. So ready for some Q&A.
I'd
Yeah,
just like to
we've
remind
got a couple
everybody that-
questions.
Yeah.
Mike,
I've
go
just-
ahead and then I'll start asking questions.
Yeah, if you want to ask a question in the chat section, if you're joining on Facebook, you can go to either where it says in the comment section. And if you do that, our Wealth Builders team will forward the questions to us. But Frank, have you got any hot questions going on?
I do.
All right.
Bill, this is from Ed Fortenberry, and thank you, Ed, for asking this. He says, I had a few people calling me to ask if they could buy a duplex I own in a lower class neighborhood in Ohio. Lead was found in the building, and I got an HHS grant to clean it up. Do people have a way of knowing that was happening, and could it be what was driving the calls? Or should I be looking to see if something is coming to the neighborhood I'm unaware of?
I doubt it's either. Ed. A lot of investors just pull public record from tax rolls of people who are absentee owners, meaning they don't live in the property, or they pull it by number of units, 2 to 4 units, and just randomly mail people. I get those all the time. Frank gets those all the time. Mike gets those all the time.
Yeah. Oh,
They're
yeah.
not necessarily having insider information. I recall when I moved to Denver in '93, and the market was just picking up, and it really wasn't. It was kind of a secret to the nation before the internet. And I remember doing a mass mailing just random like that. And I got one guy who called me and says, who are you working for? What do you know? And, he started quizzing me. He thought it was some sort of insider information about his neighborhood. It was just a random thing.
Bill, real quickly, for the people that are new into real estate, does median mean average?
No, average is everything divided by the number of properties. So you add 500, 600, 800, 1200, whatever, you add them all up and you divide it by the number of houses. That's the average. The median is the mean, if you remember from mathematics in high school. It's the middle. It's where the most common price is. So it may be the average, maybe the same thing, but not always the same number.
All right. This one is coming from the Philippines, and Lauren, I hope I'm pronouncing that right, Lozano. Thank you for asking this. I am from the Philippines. How do I know if real estate is also a good investment here in my country?
Gee,
That's a tough one.
That's a tough one. I'll give you the lawyer answer. It really depends. I'm not familiar with the Philippines. I generally tell people, invest, if you're not going to invest in the United States, invest in countries that have, number one, stable governments, and number two, that are based on English common law. So Australia, most of Europe, obviously the United States, Canada, a lot of them are based on the principles of English common law, which are, the same basic principles. I mean, the customs are different, the banks are different, the policies of banks and lending practices are different, but it's all predictably the same. Now, Philippines, I don't know enough about the government or how stable it is, or whether what your rights are as a homeowner to really give you an educated answer. But having said that, all these factors still apply, supply versus demand. There might be opportunities for up and coming areas in the Philippines that you research and discover and that you could buy, but I just don't know enough about the laws and customs to know whether there's risk involved in that.
And there's formulas that one can use to determine profitability and risk, but you also have to throw in some of the unknown factors.
Right, the X factor of what happens if there's a revolution, Venezuela or Brazil, something like that.
Robert Pontius, he's actually one of our brand new Wealth Builder coaching students.
Welcome, Robert.
And he says, how does one obtain that expired listings list?
Oh, that's very easy to buy. If you Google expired listings Atlanta, you'll find list brokers. That's anything that's public information is for sale. So anything that hit the MLS, the MLS sells that data to list companies and you can buy it.
Yeah. One of the things too, Robert, is you just got access to the legalwiz.com site, which is Bill Bronchick's site. And in there, there's a whole course on marketing that you can access. So, okay. The next one is Lydia Chan. And Lydia, thank you for asking this. Can I start? This is a good one for you, Bill. Start one LLC in one state to buy rental properties from there as well as other states, or do I need multiple LLCs? What specifics do we need to pay attention to in this regard?
Again, it's one of those lawyer answers. If you're going to ask me, can you? The answer is yes. You could form an LLC in Ohio and buy properties in California, Florida, or Texas. You'll have to register that LLC with those states as what's called a foreign entity. It's not foreign to the United States, just one state to another is called foreign. So that one entity formed in one state can buy properties in multiple states. And the question is, should you have multiple entities? And the answer I'd say is generally yes. And I'll be talking about that more at the breakout workshops at the Wealth Builders Conference.
Cool. All right. This is from Donald Vance. And Don, thank you for this. He's from Colorado Springs. How much cash on hand do I need to purchase a rental property? He's just trying to get started.
Well, that's a great question. That's a question I get a lot. The more properties you have, the less you need per property because of the law of averages. So even though, let's say in your local market, the average vacancy is 5%, 1 month lost out of 12 is 8. Right? So if you only have one property and you lose 2 months, that's 16% vacancy. If you have 50 properties, you don't need that as much per property because of the law of averages. Okay, so I would start out with probably 3 months worth of mortgage and tax and insurance payments, your principal, interest, tax, insurance, your PITI, maybe 3 months. And then once you get to 3, 4, 5 properties, then you can drop it down to maybe 2 months. Or even 1 month, depending on how many you have and, what the quality and nature and what's the turnover rate, and so forth. You'll discover what that is eventually.
Man, the questions are rolling in. We didn't have any at first, but here they come. Leanna is asking, is it better to have a real estate attorney to do the contract for buying the real estate instead of using a real estate agent looking to decrease the amount to bring to closing?
Mm-hmm. That's a good question. Well, considering the cost of an attorney versus a broker, I'd say it's really worth paying an attorney sometimes, not every time, but especially when you're buying something commercial or buying something that's not a normal transaction, an average ordinary transaction. A broker, a listing agent usually gets about 6%. So 6% of 500,000 is 30 G's. And each, the listing broker gets half and the buyer's agent gets half. So they each get 15 grand. Would it make sense to pay an attorney $2,500? That's not a trick question, especially if you're selling a property and you find a buyer, without listing it, your neighbor has a friend or someone. Should you go to a real estate agent to draw up the paperwork? Absolutely not. You're going to pay him thousands and thousands of dollars to fill out a blank form, as opposed to an attorney who could draft it up and give you better advice for your money.
All right, this one is really in your ballpark. This is from Shannon. Thank you, Shannon. What do you think of real estate funds as an investment opportunity for a 401k?
Well, an investment fund is usually, it could be a public fund like a real estate investment trust, a REIT, or a hedge fund, or it could be a private offering, just a group of investors who are raising capital to go out and buy real estate or raising capital to buy a specific piece of real estate. Yes, they can be very lucrative. They could be more lucrative than, say, the stock market, but they have their risks, of course. What is the track record of these people? Are they buying just general guidelines of real estate? We call that a blind pool, or are they buying an apartment building that you could look at the numbers and projections for, which is a little more certain? So you're going to, if that's something, you probably want to have an attorney or an experienced investor review what's called a prospectus, which is a 2-inch thick set of disclosures and documents and a business plan of what they intend to do. And if an investor asks you to invest in their fund and you say, can I see your prospectus? And they say, what's that? Run.
All right. Thank you, Bill. Ashley asks, can I quit claim a property we have from one LLC to another? It's currently in one of our LLCs, but we want to transfer it to another for anonymity reasons.
The answer is yes, you can, but there may be tax implications of that, which you're going to want to talk to your accountant about first.
Cool. All right. Liza asks, what is your advice on tiny homes, small homes as a rental investment?
What was the question?
The tiny homes. Are tiny homes a good investment?
Oh, tiny homes. They can be, depending on where you put them. If you have a piece of land to put it on and you can put several houses on there, it could be very good. If you're going to put it in a tiny home park, and that's like the equivalent of a high-end mobile home park, where they manage it for you, it's not as profitable, but it could be more hands-off. But generally speaking, I think as a vacation thing, and not as a, people going to live in a tiny home, but as a vacation thing in the right area, can be very lucrative.
All right, Bill. Hey, real quickly, this you and I have talked about this a lot, but it'll lead into the next question. What is your opinion of FSBOs for a marketing opportunity?
Well, earlier I said, look at people who have homes for sale by owner. What I meant is primarily people who don't have it actually listed for sale by owner, but they should be. If you go to a website where someone's advertising for sale by owner, you have to ask yourself, why are they doing this? Did they list it first and then it didn't work, so they would now list it on their own? Are they just too cheap to pay a broker? Do they have not enough equity to pay a broker? Do they think they're smarter than a real estate broker, which is a fool's assumption, because 95% of properties sell, at or just below asking price, or sometimes above, listed on the multiple listing, which exposes it to the mass amount of people. Even though you have to end up paying an agent fee, you usually end up netting more. So someone who listed for sale by owner just may be, dumb, arrogant, prideful, or it could be a good reason, like they just, they don't have enough equity for a broker to pay, or they already tried for 6 months and it didn't work, and now they can try on their own. So, there could be good, could be bad. In my experience, I'd say more often than not, they're just a little kooky. They have unrealistic expectations.
All right, Robert asks a couple of questions. I'm going to two-part it. The first one is, what is the best strategy for not working with a buyer's agent and instead capturing the 3% as a credit to seller?
Okay, so just to back up a little bit, when you list a property and the listing fee for the listing agent is 6%, if a buyer comes with their own agent, they split the commission with the listing agent. So each gets 3% roughly. Okay, so if you go directly to the listing agent and say, look, your listing at commission is 6%, but if I make an offer, give me a credit for 3 of it. Yeah. 3%, half your commission. And that's smart. That's very smart. If you know what you're doing. If you don't, you're probably going to need the advice of a buyer's agent. But here's another tip here too. Be leery of signing an exclusive agreement with a buyer's agent. So if you see a property and you talk to an agent and say, I'd like to see that property, will you be my agent? They may ask you to sign a 6-month commitment that everything you do has to be through them, and that's a mistake.
Second part of Robert's question is, how about with a FSBO, maybe as much as 6%? Same question, but that on the end.
Well, the problem is the for sale by owner, like I said, may have unrealistic expectations. and therefore may not go for something like that. If they're listing it for sale by owner, more than likely they're being stingy. They want to squeeze the most out, and they think they can do it without an agent.
Yeah, they don't want to pay the realtor. That's a problem. All right, Lydia, it's me again. She says, I'm based in Toronto, Canada. Are the tax rules for non-US resident LLC the same as US resident LLC?
No. Canadian government looks at an LLC in the United States as the equivalent of a corporation, a regular C corporation. So it's not a pass-through. Canadian citizens, when they invest in the United States, generally use limited partnerships, which are pass-throughs, and not meaning they're not taxed twice.
Okay. Ed Fortenberry asks, again, is a home warranty a good substitution for a property manager? I don't have a good experience with my first property manager, no profits after a year, and maybe about to buy more property than the maintenance team I assembled has time to handle.
Well, I mean, while a warranty will cover certain things that you don't have to hire a handyman for, it doesn't cover everything, like serving notices of late fees and things like that. It's not a substitute. Having said that, if you have one property in another state, and you get a home warranty program, so the tenant just calls the warranty people to fix their fridge or their stove or whatever, it could be a time saver, but I don't think it's a money saver. The cost, it's insurance, and all insurance is risk-based. And the only reason that anyone sells you an insurance policy is because their experts, who are smarter than we are, think it's not likely to happen.
Yeah.
So what you're buying is insurance. And I think if you look at the amount of money you spend for those policies versus what it actually costs, assuming you're being treated fairly and your property manager's good and not ripping you off, that's a big F. I think you'll do better with the latter.
Yeah. Leanna asks, do you think that in the market where homes are on market for longer than a month, can I write an offer asking the seller to pay for closing?
The closing costs?
Yes.
Yeah, but those aren't substantial in most markets.
Yeah.
It's only a couple percent, 2-3% at max. In some states like Pennsylvania, New York, where there's a large transfer tax, if you can get them to pick that up, that could be good, but 2-3% is not enough to make a profit.
Yeah. Leanna asks, can I borrow money against my Roth or traditional IRA to fund buying an investment property? This is in your ballpark, Bill.
Yeah. No, the short answer is no. You can on your 401k. If you work for somebody and you have a 401k, you can borrow up to $50,000 if you have $50,000 vested in your plan. And then you pay interest over 5 years back to your own plan. So let's say you pay 7% interest, your plan is guaranteed 7%, which inures to your benefit. And then you can take that 50,000 and go buy real estate. Now it's outside of the plan, so it's not tax deferred or tax free, but it's access to cash while also achieving a good return in your 401k.
Robert asks us, in the current market, or at any time actually, is there any special attraction for investing in commercial property versus residential?
Well, again, I'm going to give you the lawyer answer. It depends. Location, type of commercial. Like I said earlier, office building for the most part is in big trouble.
Yeah.
Retail, mixed, depending on where you are. And if you have an anchor tenant like a Starbucks or a Quiznos, industrial could be good, again, depending on what it's used for, where it is. So there's no short answer, but commercial, in my experience, I've done commercial real estate. When it's good, it's great. When it's bad, it's awful. So try to buy something that doesn't swing as much, because if you own like a strip center and Home Depot's your main tenant and they leave, you're in trouble.
Yeah. Yep. All right. Hey, do we have any more questions? Mike, do you have anything on your plate?
No, I just think, Bill, I think it was such a great teaching as far as you hear on the news, as far as, everything is plummeting and all of that. And how you explained it about people asking for these escalated prices for their homes and then coming back down to reality. I mean, that was just such wisdom. And because the media, you know, they blow things up and everybody takes what they are telling us. Oh, it is. It's really, really bad. And actuality, no. So I am thankful that how you broke that down. That was so helpful.
Thank you. And it may be bad. It may turn out that things are as bad as they think they are. We just, A, we don't know yet. And B, it really depends on the neighborhood.
Yeah.
Yeah, just because average or median nationwide is X, that doesn't mean it's happening in the south side of Chicago.
But I thought it was great because there are people that realize that homes were selling for all these astronomical prices in 2020, 2021. And now that things have softened, they think, well, I'm going to ask for more. And it's just ridiculous. So.
And also don't think necessarily as a buyer, you could steal those properties, because a lot of sellers have said, you know, I got a 2.9% mortgage. I could rent it.
Yeah.
Sit on it indefinitely.
Sure. It's good info.
Yes.
Thank you. And I'm looking forward to speaking and meeting with and answering questions at the Wealth Builders event. It's just a tremendous opportunity for all of us. And I highly encourage those of you who haven't signed up to get signed up.
Bill, do you know what you're going to be talking on specifically or not yet?
Well, I'll be talking about real estate investing from a sort of a, you know, the 30,000-foot view. And then we'll have breakout mini workshops where I'm going to talk about things like how to set up your corporate entities for real estate for maximum protection and lower taxes, and how to do creative financing without using banks and things like that. So a lot of information.
Sounds good. All right. Boy, thanks, Bill. Mike, I'm going to turn it back over to you.
Well, just like Bill said, Wealth Builders Conference is February 17th through the 19th. You can go to wealthbuilders.org/events. And there's also going to be live streaming for that, Bill. So there'll be in person as well as live stream. There's more information on the website. And unless we have any more questions, I believe we got them all. Is that correct?
I think, yes, we did.
Yeah, I just want to add one thing to that live streaming. If you absolutely can make it, live stream it. But if you could really make it, because there's such a dynamic of being there live, and the excitement and just the connections you make, the people you meet. You never know if the person sitting next to you or in front of you or behind you might be your next partner, might be your next lender, or might be buying properties from you.
Bill, many of us have run into the Holy Spirit there too. So
yeah, I don't think the Holy Spirit gets through on streaming. I'm not sure about that. I'm not an expert on the Holy Spirit and virtual.
Well, I believe God can talk anyways, but I'm glad you brought that up, Bill, because it is night and day, to be honest. If you can't make it, then by all means live stream it. But if you're there is such a strong connection, and just being in that atmosphere, Bill, I mean, it's just a different atmosphere. People are ministered to, and there are we've already had, Frank, haven't we? Great people that have made connections, and to be honest with you, lifelong friends from being a part of this. So it's absolutely a great conference. You should try your best to be there in person, February 17th through the 19th.
Yeah, and they put on a tremendous event, very professional, you know, no expense spared. And it's just a tremendous environment, and the people are great. I just love the people I meet at Wealth Builders.
And it's a wealth of speakers. And Billy and Becky, I mean, Billy is like you. Billy's been doing this for a lifetime. And so they put on a great event, and we are so looking for it. And I'll tell you what, it's 1 month away, so it'll be here before we know it. But we want to thank you, Bill. Thank you, Frank. And thank all the Wealth Builders team for helping us put this on. And we look so forward to seeing you next month. God bless you guys.
God bless. Bye-bye.